Hello traders, welcome back to yet another episode of the free Smart Money Concepts course. In this episode, we are going to learn another important topic in SMC, without the knowledge of which trading in the markets can be tricky as well as risky. It is none other than inducements. Some traders ignore the significance of this topic, while many others don't use it in the proper manner. We will try to fix this. So in this video, we will understand what inducement is and what its significance is. Then we will learn different methods of identifying and spotting inducements in the market. Further, we will discuss about the different types of inducements, namely major and minor inducements. And finally, we will understand the difference between inducements and change of character. So watch the video till the end to gain complete understanding of the entire topics. So let's get started. Now there are different ways in which you can define an inducement. But I would like to think of inducements as an area or level where retail stop losses can be hunted, or simply think of it like a trap in the charts. The proper definition of inducement is that inducement is an area of deception where most traders believe it is the correct and right time to enter a trade, leading them to take wrong decisions at the wrong locations and in the wrong direction. So the idea of an inducement level is to induce or persuade traders to buy or sell at the wrong location, thereby leading them to a trap. Now, inducement is a concept based on liquidity. For example, think of it like a level where retailers find an opportunity to take a trade. But for someone who follows smart money concepts, inducements give them an opportunity to take a counter trade against these retailers. Or in other words, inducements signal SMC traders that it is now feasible to take a trade. It is always advised that until and unless there is a proper inducement in the chart, one should not even think about entering into a trade position. This is because the chances of it being a trap otherwise is very high and you might end up in losses. So the reason why this is particularly important is because of the fact that inducement follows the nature of liquidity. So if you have noticed, liquidity follows an accumulation, manipulation, distribution cycle, also known as the power of three. Let me explain this. Accumulation represents a stage within the market cycle where prices tend to consolidate while engineering liquidity on either side. The manipulation phase follows the accumulation and is often marked by sudden and sharp price movements that catch retailers off guard. Manipulation occurs in the opposite direction of the real move, and it is aimed to stop out the retailers and induce the breakout traders. So understanding the intentions behind manipulation phase is very crucial. Smart money uses these moves to acquire more shares or assets at favorable prices. By triggering stop losses and inducing breakout players, they generate enough liquidity for their positions. They accumulate positions while retail traders are caught on the wrong side of the trade. Now comes the distribution phase. After accumulating at the best possible valuations and manipulating the market to their advantage, smart money begins to unload their positions to those eager retail traders who are late to the game. The distribution phase in SMC is quite a bit different from the distribution phase that we have learned in the price action course. Here, during distribution, the smart money slowly offloads their holdings, typically in a controlled manner. They distribute their shares to the retail traders who are jumping in, eager to open new positions at higher valuations. This influx can sustain the rally for a while. This AMD concept emphasizes that recognizing these phases is essential for successful trading. By understanding when smart money accumulates, manipulates, and distributes, traders can align themselves with the dominant forces rather than getting caught on the wrong side of things. So this is the whole concept behind inducements also. There are other significance of inducements which we will talk about in a short while. Now, how exactly can we find inducements in the charts? What are the things that we need to consider? So there are two methods which you can apply to find inducements, both of which has certain limitations of its own. These are the first pullback method and the trendline method. Let's talk about the first pullback method. This is actually the first pullback after a break of structure. The idea is quite simple. An inducement is considered as the first pullback after a valid break of structure has happened. These pullbacks are minor pullbacks or internal pullbacks, which can be formed using a single candle, a group of candles, or even a deep wick. You can see the different types of pullbacks that you can find on charts here. Even though we consider inducements as the first pullback after a valid break of structure, in certain scenarios, we might need to tweak this rule by a little bit. Let us understand this using a few examples. we will first consider some bullish market scenarios on a major market structure. Before that, make sure you have a fair understanding about the market structure mapping. You can watch that video in my SMC playlist. Anyways, here we have 4 situations. We will take a detailed look at each one of them. In the first case, we can see the price break and close above the previous major swing high. This is our valid break of structure. Now let us see what happened after the break of structure. You can notice how the price moved higher and then it formed a minor pullback. As per our definition, the low of this minor pullback is our inducement level. We can draw a small horizontal line at this low to mark the inducement. For easy identification of this line in the future, we can name this line as IDM, or you can even use a dollar sign for the same purpose. Now you can see what happened next. The price moved lower and break below this inducement line. This means that the liquidity below the inducement level has been absorbed, or the uninformed retail traders are trapped. Only when the inducement level is taken out should we start thinking about a trade. Mostly, the market will move in the direction of the existing market trend after taking out the inducement. But this does not have to happen immediately. The price can reverse after sweeping a liquidity area, or it can reverse from an order block also. So inducement is a useful concept before taking a continuation trade. But as always, this cannot be said with 100% accuracy. There can be such instances where the market could just fall lower and break below the major swing low and thereby forming a change of character instead. Now moving on to the second example, in this case, we can observe that the price moved higher and it break above the previous swing high level. But the price did not manage to close above the previous higher high, so this is not a valid break of structure. Therefore, we cannot spot the inducement yet. And what happened afterwards? The price did manage to break and close above the previous major swing high level. So now we have a valid break of structure. Now the price moved even higher and formed a minor pullback. Now we can mark the low of this pullback using a line. This is our inducement level, which is denoted by IDM or a dollar sign. But as you can see, the price did return back to take out the liquidity below this inducement level. Keep in mind that only after the inducement is taken out should we think about taking trades from an order block or from an area of liquidity. Inducement is also used as an order block filter. The idea is that inducement levels are considered as smart money traps because it induces retail traders to take a short trade from an inducement level which is above the price of interest or demand zone during a bullish market structure, thereby making them to trade in the wrong location as well as in the wrong direction. For those who are unaware of what price of interest is, POI or price of interest is a price level or a price zone where there is a very good probability that the market could react with it and respond accordingly. A POI is also called DP or decision point by some experts. So a POI can be any of the following. It could be an order flow, an order block, a supply or demand zone, session highs or lows, daily or weekly or yearly highs and lows, or it could even be price caps. In a similar manner, inducement persuades retail traders to enter into a long trade position from an inducement level, which is below a price of interest or a supply zone during a bearish market structure, thereby making them to trade in the wrong location and in the wrong direction. So most often or not, price will break this inducement level and take out the retailer liquidity. So this is a very common smart money trap, and this is why it is always recommended to take trades once the liquidity associated with an inducement level is taken out. Because once the price has swept the liquidity associated with an inducement level, there are good chances that the price can reverse without testing any price of interest or supply or demand zones. I hope things are making sense. Now look at this third example. Where is the inducement in this case? It is clear that the price did form a valid break of structure, but as per our definition of inducement, the price did not create any minor pullbacks after the bullish break of structure. But the price did form a pullback just before the break of structure. So in such instances where there is no pullback formed after the break of structure, we will consider the last minor pullback before the break of structure as the inducement level, and we can mark it using a line and name it. Now look what happened next. The price did return all the way down and took out the liquidity below the inducement level, and then it moved higher. So this is a special case where we have to make adjustments and not blindly follow the textbook definition of inducements. Now take a good look at this last example. Here the price gave a clean breakout above the previous higher high. So it is a valid bullish break of structure. Then the price moves higher and forms a minor pullback. So as per our rule, we will draw a line at the low of this pullback and mark it as our inducement. Now, did the price return to grab the liquidity? No, the price did not come back. Instead, the market moved higher and then it formed another minor pullback. Now, what will we do? If such a case takes place, we should shift one inducement level forward to the low of this newly formed pullback. And even if the price don't take out this new inducement level and it moves higher and then create another pullback, then without any doubt, we should shift our inducement line to this new low formed. This is yet another important concept in connection with the basic rule of first pullback. And as you can see, the price returned to sweep the liquidity below the inducement level, and then the market continued higher after absorbing all the liquidity. The idea remains same for bearish instances also. Let's quickly look at a few examples for bearish market structure. In the first example, price formed a valid break of structure. Then it moved lower and made a minor pullback. So as per the rule, we can draw a line at the high of the pullback and mark it as the inducement level. The price did come back and sweep the liquidity above this line. Moving on to the second example, here the market did not give a valid break of structure at first. Then price consolidated a bit and then finally it break and close below the previous swing low level, thereby forming a valid bearish break of structure. And then once it moved lower, it formed a minor pullback. We can mark the high of this pullback as our inducement. Then we can see that the price returned to take out the liquidity above the inducement level. So an important point to be noted here is that you should never look for an inducement until there is a valid break of structure. Now in this third example, the price created a valid bearish break of structure, but the price did not form any minor pullback on the way down. Instead, it formed a corrective move towards the upside. In such cases, we can mark the high of the last pullback before the break of structure as our valid inducement level. In this scenario, you can see how the price moved higher and took out the liquidity above our inducement level and then fell lower. In the last example, the market formed a minor pullback after a valid break of structure. Then we can mark the high of this pullback as our inducement level. But the price declined even lower without grabbing the liquidity. Then it formed another minor pullback on the way down. In this case, we can shift our inducement line to the high of this newly formed pullback. And we can notice what has happened afterwards. The price swept the retailer liquidity above this inducement level. Now, let me remind you again that you should never think about taking a trade until and unless the inducement level is not taken out. This is mandatory if you are following smart money concepts. Now, always keep in mind that inducements should be marked on the impulse move that caused the break of structure. It should not be marked on the corrective move like in this case. This is the wrong approach. The only exception is when the market forms a valid change of character, in which case the correction move gets converted into the impulse move of the counter trend. Take a look at this scenario. Here, the price break and close below the previous higher low level, thereby confirming a bearish change of character. In this instance, we have to look for inducements in the price move that has caused the change of character. In that sense, we have to mark the inducement at the high of the first minor pullback after the valid bearish change of character. So make sure you are marking your inducements in the right manner. Another importance of inducement is that it helps to identify and confirm the higher highs in a bullish market structure, and it helps to confirm the lower swing lows in case of a downward market structure. In the market structure mapping episode, I have mentioned that you need a deep pullback after a valid break of structure to confirm your higher highs in case of a bullish trend, and also to confirm your lower swing lows in case of a bearish structure. I asked you to use Fibonacci retracements to identify deep pullbacks, but this is a time-consuming process. So a rather simple hack is just to identify the valid inducement level. Then the highest point above this inducement line, once its liquidity is taken out, will be our higher high in case of a bullish market structure. Similarly, the lowest point below the inducement level, once the liquidity above the inducement is grabbed, will be our lower swing low in case of a bearish market structure. Now let's talk about the second method of identifying and marking inducements, which is by using trend lines. The idea is very simple. Let us consider a bullish market scenario. Keep in mind, whatever happens, we will look for inducements only after a valid break of structure. Here you can see how the price break and close above the previous higher high, thereby forming a valid bullish break of structure. Then the market moved higher. What we will do is that we will draw a trend line connecting all the minor lows within the major swing. Or in other words, we will try to connect all the internal swing lows using a trend line, as you can see in this figure. Then we will wait for the price to break and close below the trend line, which will in turn induce retail traders to sell because of a trend line breakdown. All these retailers will be trapped and their orders will be taken out. Now, in a bearish market structure, we should look for a valid bearish breakout structure below the previous swing low level. And when the price falls lower, we can mark all internal highs formed after the recent swing high and then connect all these minor highs as and when they are formed. And when the price breaks and closes above this downward trend line, we can expect retail traders to take buy positions as they have spotted a trend line breakout. This is our inducement. All these retail traders will be trapped and their orders will be absorbed. Now, there are a few problems with this trend line method. First of all, trend lines are subjected to human errors. This means different traders would draw and interpret trend lines differently. So the inducement identification varies vastly from person to person. So this confusion is not a good thing. The second issue is that sometimes even after a breakout below the trend line, the price would not move below the inducement low, which means the liquidity below this level is not absorbed. This could lead to wrong analysis. Because as per our pullback method, the inducement level gets shifted to newly formed pullback lows as long as the liquidity is not swept by the market. So from my experience, it is better if you stick with the first pullback method after a valid break of structure for marking your inducements. Now let us talk about major and minor inducements. You might have already guessed what these are. Anyways, the differentiating factor between the major and minor inducements are the time frames. It will also depend on your trading style. So if you are an intraday trader, then your higher time frame can be 15 minutes, while your lower time frame can be between 1 minute to 5 minutes. So if you were to map your market structure and mark your inducements on a 15-minute higher time frame, then you are indeed marking the major inducements. Now, if you start mapping the structure and mark all the inducements on a 5-minute lower time frame, and then consider all the internal price swings and the associated break of structures, then you're drawing the minor inducements. On a similar note, if you are a swing trader, then your high time frame can be 1 day or 4 hours, whatever it may be, and your low time frame could be 1 hour. In this scenario, your major inducement is marked on your higher time frame major or external structure, while your minor inducement is marked on your lower time frame structure, which is 1 hour, and considering all the internal price moves within the major swing structure. Now, the idea of identifying and marking minor inducements are also the same as with major inducements. But because we are making use of lower time frames and also taking into consideration the minor or internal structure, we will be faced with a lot of minor structure breaks. This will result in a lot of inducements getting formed. These minor inducements can be helpful for those traders who wants to collect some quick profits while waiting for the price to take out the major inducement level. But there is a small change in concept when it comes to minor inducements and change of character in a lower time frame internal market structure. So let's clear that out. So this is a bullish market structure on a higher time frame, and to the right is how the lower time frame structure looks like. And as you can clearly see, in the lower time frame, the internal price swings are quite detailed and visible. Now let us mark the breakout structures in the minor time frame. Once the breakout structures are identified, let us find the proper inducements. We will try to mark the inducements as per the first pullback after the breakout structure rule. Now, since we have marked the bullish breakout structure, we will have to spot the lows of the first pullback. Here, I have marked all the lows of the pullback, and we can draw a line at these lows. These are our inducements. Now, we can see how the price reacted in these inducement levels. Now, let us focus our attention on this last inducement level before the market reversed lower. So before it reversed, the price tested a supply zone or a price of interest. So this is not really an inducement, but instead this is a change of character or CHoCH in the minor structure. So the simple difference between an inducement and a CHoCH in a minor structure on a lower time frame is that inducement is the first pullback after a valid break of structure, but a CHoCH becomes that inducement level before the market tests a price of interest. Let us look at a bearish case also to help us understand the idea even better. So first, you need to go to your higher time frame and map the structure. That is, you need to find your lower highs, lower lows, breakout structures, and change of characters if any. Then, you need to mark the major inducements in this higher time frame structure. So if you are an intraday trader, map your structure on the 15 minutes higher time frame. The next step is to move to your lower time frame, which can be between 1 minute and 5 minutes. Let's take 3 minutes for our purpose. In the 3 minutes chart, you will get more granular details on the internal structure and a lot more of swings. Now start identifying the valid minor breakout structures when the price break and close below the previous internal lows. Then start identifying the minor inducements, which are actually the highs of the first pullback after a valid minor breakout structure. Now this last inducement before the price reversed after testing a price of interest or a demand zone will be our change of character. So in the market, change of character can happen on two occasions. First of all, as you may already know, a CHoCH happens on a major market structure when the price breaks and closes below the previous major swing low in case of a bullish market, resulting in a bearish change of character, or we can say there is a change of sentiment from bullish to bearish. It can also occur when price break and close above a previous major lower swing high level, resulting in a bullish change of character. The second scenario where a change of character can be identified is on a lower time frame internal structure where your inducement becomes a change of character when it tests a price of interest and reverses. I hope things are clear. So these are all the important things that you need to know about inducements as an SMC trader. Inducement is one of the most vital liquidity concept in the whole of SMC course. So make sure you learn the concept properly, practice it on different charts, backtest it to find out if it actually works for you, and take trades to get comfortable using it. I genuinely hope that this video was useful to you, and if you have learned something new, then make sure to hit the like button and also share this video with your friends and fellow traders. And if you're new to this channel or you haven't already subscribed, then make sure that you subscribe to this channel and also enable the bell notification so that you'll be reminded when a new video gets released. I will see you guys in the next episode. Till then, bye.